Hi, it's Bob Hoopshire, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder and CEO of Advisor Perspectives. Direct indexing is the most powerful trend sweeping through the advisory profession. When done right, it lets clients build low cost, tax efficient, and highly customized portfolios. Those portfolios can track a broad market index or implement a factor based strategy. They can follow an ESG or sustainability mandate. Here to discuss the latest developments in the direct indexing world are two members of Envestnet's management team. Brandon Thomas joins us as QRG's managing principal and chief investment officer and is responsible for the firm's strategy and oversees portfolio management capabilities. Brandon is also a co founder of Envestnet and the co chief investment officer of Envestnet. As QRG's principal and director of quantitative research, Giannis PhD, CFA, is responsible for leading QRG's research efforts and oversees the firm's trading functions. Giannis is a member of both QRG affiliates Envestnet PMC and Envestnet Retirement Solutions investment committees. I'm going to ask each of you to start off by telling me about your career paths and what led you to your leadership roles at Envestnet. Giannis, you want to start?
Absolutely, Bob. Thank you for having us on the show. My path was somewhat winding in the sense that I didn't really have a focus on getting a role in quantitative finance. I started as an econ major. I have a degree in statistics and financial math and finance. And my first job out of school was with Ibsen Associates as an analyst, and then I transitioned to Misra Financial, and from there to Envestnet. And initially at Envestnet, I was working in retirement services group, but at some point I approached Brandon about starting QRG. This is some 10 years ago. And Brandon was gracious enough to give this idea, a chance, and the rest is history.
Well, thank you. And Brandon?
Yeah, and Bob, I too would like to just say thanks for having us on the program. Yeah, I started in the investment management business soon after graduating from college, and this is way back in the mid 1980s. So I've really got over 35 years of experience in the business, which is probably maybe too long of a time. But I had met Judd Bergman, who was the founder of Envestnet at Church in 1992. And he recruited me to Nuveen Investments, where he was a managing director there. And I then became the director of equity mutual funds at Nuveen. Judd developed this idea behind Envestnet while he was at Nuveen, and he asked me and a couple of others to help him launch it. So we left Nuveen in 1999 and then formed Envestnet. Giannis mentioned that he joined the firm about 15 years ago, and really he and I have been partnering ever since in building QRG and in our asset management capability.
So let's start off by understanding what QRG offers in the direct indexing space and what have you guys seen that has been most popular with advisors and their clients? Brandon, you want to start off?
Sure. Quantitative Portfolios is the brand that we use at QRG for our direct indexing solutions. And QRG, I should say, is an affiliate of Envestnet. We are a subsidiary, a wholly owned subsidiary. QRG is an RIA, GIPS verified RIA, and we're a wholly owned subsidiary of Envestnet. So when I mention QRG, it really means Envestnet. But Envestnet's clients have had access to these quantitative portfolios, or QPs as we call them, for almost 10 years now. And we offer direct indexing strategies in the form of these QPs in 4 different series, 3 equity series and then a new fixed income series. On the equity side, one of the 3 are what we call the market series. And those are really just pure passively managed strategies where we're not trying to outperform the index. We're trying to obtain asset class exposure, whether it's domestic large cap, small cap, international developed, emerging markets, whatever it might be. We want that asset class exposure to track an index that represents that asset class very closely. We're not trying to outperform with these strategies. These market series strategies are very popular with clients that want a low-cost asset class tracking solution. And it's probably our most popular direct indexing solution because its objective of obtaining low-cost asset class exposure is really what advisors have come to think of in terms of direct indexing. The second equity series is what we call our factor enhanced series. Now, these are still quantitatively constructed, like our market series, systematically managed. But in the factor series, we're not just trying to track the index, we're trying to outperform it through quantitative exposures to various well-known asset pricing factors that have performed well over time. Academic research has identified a handful of such factors with value, momentum, quality, and profitability being among the most robust. When a portfolio is tilted toward these types of factors, it's expected to outperform over time, not all the time, but over time. And this series is probably our second in popularity to our market series by only a slight margin, because many advisors are adopting factor-based philosophies as an alternative to traditional active management. We've got a third equity series, which is our sustainable series. Again, we're not trying to outperform the market with this strategy, but we're trying to track it very closely with tilts toward companies that have high sustainability and ESG ratings. For example, they may have a low carbon footprint. They are very customizable because clients in this area have unique needs and preferences when it comes to sustainable investing, and they want to align their values with their investments. These aren't in extremely high demand at this point, but we expect that over time, adoption of sustainable strategies has the opportunity to grow. And then we just launched a fixed income series, which includes investment grade corporate and investment grade municipal bond ladder strategies. 1 to 10 years, very quantitatively constructed, using a rigorous methodology, and they're designed to provide consistent income for clients and a buffer really to rising interest rates as we're seeing right now. So that's how we sort of have designed our direct indexing strategies, and we'll continue to build out the capabilities there over time.
Giannis, I'd like to see if is anything you'd like to add to that, but more specifically, I'm interested in, can you expand on those factor strategies and talk a little bit about how QRG views factors in general?
Absolutely, Bob. So basically, from a purely theoretical point of view, outside of stock picking alpha, every type of return is driven by factor investing, right? So whether it's intentional or unintentional, so we can think about every return investment or every investment approach as factor investing. Professor Andy Ng has a very, very nice quote, which says, asset class return is a bundle of factors. So every asset class is a bundle of various factors. For me, and I imagine for our group as well, the quantitative factor investing is really about being very precise and intentional in putting together our portfolios with factor exposure in mind. So not only do we think about factors when we construct our factor portfolio, but also we think about factors when we put together market series. Brandon mentioned market series. So these are portfolios that are intended to track an index. But even there, what we're essentially are doing is we're matching the factor exposure of the index and factor exposure of the portfolio. And so being very intentional and precise in defining these factors, and then either matching the index or overweighting factor exposure of the index is what quantitative factor investing is all about. Factors are descriptions of risk dimensions. So we are all, of course, familiar with market, but value, momentum, quality, and so forth, these are basically descriptions of additional factors in addition to market. Divide the factor universe, and in fact, Professor John Cochran from University of Chicago called this factor zoo. There's a multitude of factors out there, but we can divide them up in two large groups: macro factors. So these are factors that impact across asset classes, right? So across equities, fixed income, currencies, commodities and so forth. And then we have style factors. And so within macro factors, we have things like economic growth, inflation risk, real rate risk. And inflation risk and real rate risk are very, very prominently seen right now in the economy. There's commodity risk factor, there's currency, and illiquidity, actually, a very important one as well. So these are macro factors that drive the performance of asset classes themselves. And then we can talk about style factors. And these are factors that affect the performance of individual stocks within an asset class. And in the style bucket, we can talk about things like value factor, momentum factor, quality factor, low beta, low volatility. There's requirements of what we mean by a factor. And so one might ask, with this multitude of factors to choose from, and there are literally hundreds of, if not thousands of papers out there published on a number of factors out there, how do you choose what is a legitimate factor? There's a list of criteria that we use at QRG to kind of sift through all of the academic literature and kind of that have had good historical performance and we think will have risk premium also going forward. Factors should be justified by academic research. They should exhibit significant risk premiums. Otherwise, why care? They should not be susceptible to perturbations in the definition of the factor themselves. And by the way, I should mention that all of our factor construction we do in-house. We are able to not only construct the factors, but also highly customize our portfolios. We've tested various different definitions of factors. So what we use in our risk model are factors that are not susceptible to these perturbations in the definition. For example, you can define value, with a PE ratio or book to market ratio or price to sales ratio or in any other different, number of different ways. And it's important that as you change these definitions, the factor performance doesn't change. And, finally, it's important that we are able to implement the factor in liquidly traded instruments. Otherwise, if you have some kind of esoteric factor and you can't really arrive at it, maybe the factor premium that you're calculating has to do with illiquidity factor rather than some other factor. The factors are descriptions of various risk dimensions, and we are very, very thoughtful in terms of putting together our portfolios, not only the index tracking portfolios, but factor overweight portfolios. That's our general view of the factors.
Thank you. Brandon, what can you add to that?
Hearing Giannis talk, you can tell that we're huge proponents of factor-based investing. Really, factors are not only applicable to our factor-enhanced strategies, but also our market series and sustainable strategies. Everything we do is sort of revolving around factors. And I think of, taking it up to the advisor level, I think of factor investing as occupying the quantitative active management space within the direct indexing category. The asset management industry, as well as some advisors and investors, think of direct indexing as a completely passive strategy, just trying to track an index. But we include quantitative active management, meaning these factor-based approaches within direct indexing. We lump it under that umbrella. And building what I mentioned on earlier, the concept behind factor-based strategies in general, and then our factor-enhanced strategies specifically, is that certain factors that Giannis has outlined have exhibited robust performance over time. And when we thoughtfully capture these exposures to factors, the portfolio can generate excess returns over time. And that's why we consider them to be quantitative active and alternatives to traditional active management. Do factors always perform well? No. We've been through a period over the last year and a half where they have performed well. But for the 5 years or so prior to that, factors generally did not perform well. And during that time, there were a lot of advisors and investors questioning whether factor investing was really worth it. And factors will go through periods of difficult performance, but over time and across all asset classes and markets, one can expect that tilting toward these factors will enhance their portfolio returns. And then regarding the current environment too, and I think Giannis would agree with me on this, we believe that factors are particularly attractive given where we are now in the market and the economic environment. Over the last 12 years or so, we've been in this unique monetary policy period where we've had quantitative easing, abnormally low interest rates, and now because of inflation and some of the things that are going on, we're starting to get back to a more historically normal type of monetary policy environment, and that makes factors sort of favorable to perform well. And so over the last year and a half, as I mentioned, factors have done very, very well. And we're doing a lot of research in this area as to what to expect going forwards in terms of factor performance.
And we're going to include some links to that research in the notes that accompany this podcast. How have you two been seeing advisors best utilize the tax efficiency that these quantitative portfolios offer?
Well, tax efficiency is, of course, one of the key benefits that's been promoted with direct indexing strategies. And there are a few reasons why QPs specifically and most direct indexing strategies generally tend to be excellent vehicles for it. Because these solutions are implemented in separate accounts, the client owns the individual tax lots. So tax loss harvesting and offsetting of gains with losses is very efficient and easy to do within the operational and technology capabilities that we have. As far as use cases go, QPs are excellent vehicles, direct indexing strategies generally are excellent vehicles to use in tax transition cases. A lot of the cases that we get in taxable accounts are situations where the client has existing positions with low cost basis and they fund the account in kind with these securities. These positions are typically either a very concentrated number of positions or they're more diversified. But as I said, typically the positions have a low cost basis and the client wants to transition into something that's more diversified, but in a tax efficient manner. They don't want to realize a lot of gains, especially short-term gains. And direct indexing is tax efficient because QPs and other direct indexing strategies really hold more positions than a typical separate account. Some of our strategies hold more than 200 positions. And while that seems like a lot, it allows for more opportunities to harvest losses or offset gains with losses. And that's difficult to do in a traditional actively managed strategy that may have 40 or 50 positions. And you don't have the variety of gains and losses in the portfolio that you can effectively tax manage. And our clients often apply tax overlay services to our strategies, our quantitative portfolios. And in fact, the vast majority of our taxable accounts employ some type of tax management, whether it's a tax transition case where they want to get into something more diversified in a tax efficient manner, or they're funding the account with cash and they just want to have ongoing tax management. We've got very robust performance reporting that shows the so-called tax alpha from implementing these strategies. And the tax efficiency and the tax benefits of using direct indexing strategies is very measurable, and a lot of taxable clients are really focused on that.
Giannis, how customized can these strategies be made? For example, can you minimize or eliminate exposure to a single security? And how does QRG simplify that process for advisors?
Right. So I touched upon the customization nature of our approach earlier on. So all of our methodology, starting from factors all the way up to optimization engines and backtest engines that we've constructed, is built by our team. And so what that means is that we can customize, literally every aspect of that aspect of the strategy. And what I'm talking about are things like the universe, for example, large cap, small cap, international, emerging markets. The type of strategy that the client wants. Whether it's factor exposure, tracking an index, ESG type of strategy, or combination thereof. Number of securities in the portfolio. Various factor constraints. How much to overweight a particular factor. ESG, there's a multitude of ESG constraints and so forth. Turnover constraints, definitely individual security exclusions, individual, sector exclusions. All these type of things are customizable in our engine. Again, mostly because the methodology that we've created and the optimization engines that we've written are done by ourselves, and we control each and every detail of the process. how we make this easier for the advisors. I'd like to mention two things. One thing, we have put together the strategies that would be broadly appealing to advisors into investable strategies. And those are products that are available to advisors and our clients on our platform. And this list is ever expanding. I mean, we literally roll out new products on a monthly basis. But the other thing, and Brandon is a bit more involved in this effort than I am, but we are putting together a utility and a tool that would allow advisors get access to some of this customization capabilities that we as a group have. Include all the dimensions that I talked about: universe and strategy, number of stocks, factor constraints, ESG constraints, of course. This is a new effort and a very promising effort, and we expect that clients will really respond to it.
Brandon,
as Giannis mentioned, customization is kind of key to these types of strategies. And there are really two levels of customization that clients have come to expect in direct indexing strategies. One is to say, it's sort of a base level of customization where they take an existing strategy and make some restrictions to the account, such as security, sector, industry, or perhaps ESG restrictions. These are really common, easily implemented. And then Giannis touched upon that real enhanced level of customization, which is that second level. And this type of customization is really along the lines of creating an entirely bespoke strategy where a standard offering doesn't really meet the client's needs. And here we help the advisor, just create a completely unique strategy that reflects the desired customizations and preferences of the specific client. And as Giannis mentioned, there are just literally dozens and dozens and dozens of different dimensions that can be customized in constructing this type of bespoke strategy. It's really more of a white glove approach, but as Giannis points out, we have technology that enables us to scale the optimization of the custom portfolios and then manage them on an ongoing basis. And we're going to be introducing in the near future a tool called the Personal Index Portfolio Builder that will allow advisors to create these bespoke type of strategies along with this multitude of dimensions that they can customize.
Brandon, we're in an environment now with rising rates. We're recording this on September 30th. The 10-year is nearing 4%. I believe it reached that level earlier this week. We're in a equity market that's in bear market territory. We're facing very high inflation. Given that backdrop, how are these strategies suitable for advisors?
Yeah, no, it's an excellent question. And I think that direct indexing strategies are really, I refer to them as all season vehicles. They're terrific in this type of environment, not only, a normal type of environment, but in this type of environment as well. And sometimes a client just wants to be completely passive because they know it's difficult to outperform the index. And since it's historically proven to be very difficult to outperform the market, our passive market series and sustainable strategies are always useful. There's an increasing amount of focus on these sustainable strategies, and they're also useful in this type of market environment. You see more advisors and managers interested in this area, which makes these types of strategies where a client can gain exposure to an expanding palette of ESG and sustainability dimensions very useful vehicles. And they tend to be, these types of ESG sustainable strategies tend to be more focused on the quality factor that Giannis pointed out earlier. And the quality factor, there's a safety component to that and low volatility component, which helps to enhance performance, relative performance in this type of market. And then our factor enhanced strategies are particularly attractive given the environment you just mentioned. I mentioned this unique monetary environment that we've been over the last dozen years or so, and now we're starting to see the Fed normalizing its interest rate policy, unwinding its balance sheet, and getting back to a more normal monetary policy environment. What that does is it makes it just sets up well for factor performance. There's more distinction among stocks in that type of performance. And we've seen over the last, as I mentioned, last 18 months, factors have performed well. And, we believe that as happened after the tech bubble in 2000, and then after the Great Recession, as it's called, in 2009, we're going to see a multi-year tailwind for factor performance. That's our belief. And this environment will lend itself very well to factor-based strategies. They performed well over the last 18 months, but we think we're in the early innings of that type of outperformance. And QPs and direct indexing are useful for advisors and their clients that have a desire to provide low-cost solutions designed to consistently achieve certain objectives, whether it's asset class exposure or exposure to sustainable dimensions or exposure to factors. It's really a philosophical decision by the advisor, and it's really based on low cost and just obtaining those exposures that they want.
Giannis, tell me more about the fixed income offering and what those strategies entail.
Initially what we've done is we've rolled out two ladder portfolios, one for corporate bonds and one for munis. This is our initial foray into fixed income world. There's many other products and strategies we're planning to construct in the fixed income space, specifically fixed income factors and index tracking strategies and so forth. First initial strategies are ladders, and they are highly customizable strategies in the sense that we take into account person's tax situation, which is specifically very important on the muni side. We have the ability to take into account the current holdings that the person might have in terms of existing QSIPs and existing bonds. The strategy, of course, is, as all the things that we're doing is quantitatively driven. In our quantitative process, we focus on things like high quality bonds. So we have access to the whole universe, of course, of QSIPs out there. We look at, the credit quality of the bond. We look only at senior bonds. We look at top 200 largest issuers out there in terms of market cap. We have some basically restrictions on types of bonds that we invest. For example, we don't invest in bonds that downgraded in the last 3 years, for example. And then, using that as a starting universe, we find a ladder portfolio that is very well diversified, as well as provides maximum possible yield. And on top of that, I would like to also mention that we pay specific attention to efficient execution of these portfolios because, especially in the muni world, that is an important consideration. We trade on a platform, a trade web platform. That's the name of the platform. It is used extensively by retail customers as well as large institutional customers. And importantly, what we can do is we can obtain the prices, the posted prices and yields right before the optimization process starts. And the reason that this is important is because we already know what the price is going to be before we start trading, and therefore we can incorporate this price into our optimization process. And in that way, we're essentially not only maximizing the yield, but also we're minimizing the transaction costs that we might expect when we trade these portfolios.
Thank you. Brandon, we've talked about the market series, the factor-based series, the sustainability approach, and also now the fixed income approach. What are the costs of those services, and where can listeners learn more about QRG and access these quantitative portfolios?
Yes, the fees on the strategies are, we think, very competitive, very low. Our market series strategies are priced at 15 basis points, and then they tier down depending on the account size. So they start at the very lowest account level at $100,000, and then they tier down depending the larger the account goes. For our factor strategies and our sustainable strategies, those are priced at 20 basis points, and they tier down. And so what you have is, in most actively managed SMAs are in the 50 basis point range. You're getting either a pure beta solution in our market series, for roughly 35% of the cost of an actively managed solution, and even our factor-based strategies, which we think of as quantitative active. They're very good alternatives to traditional active at 20 basis points. There's a meaningful reduction there in fees. And then our fixed income strategies are extremely aggressively priced at 9.5 basis points. So a very low cost solution if advisors just want to build portfolios using these types of strategies. Now, where can they go to learn more about QRG and the quantitative portfolios? I would point them to our website, which is envestnet.com/QRG, envestnet.com/QRG. And that site has a tremendous amount of information and research regarding the QPs. We've got fact sheets, commentaries, rebalancing information about the QPs. We've got information on the team, research we've published. And if if an advisor would like to schedule time to speak with one of our consulting team members and do a deeper dive, they can fill out the contact form on that same site, and we'll be in touch soon thereafter.
My question for each of you is if there's one key takeaway that you would like to leave with our audience of advisors about how direct indexing can help their clients achieve their financial goals, what would that be? And I'm going to start with Giannis.
Yeah, I would like to echo Brandon's earlier point about the very special environment, economic environment that we're in right now. It's in some sense unprecedented due to monetary and recent monetary and fiscal policies. One of the tasks that QRG does for Envestnet is we construct capital market assumptions each and every year, and as part of that process, we do these returns for fixed income asset classes, equity asset classes, and each and every year we've seen these expected returns slip going forward, and it's not only our expected return downward trend, but also other providers agree with us on this. There's a move towards private asset classes to kind of alleviate this problem. But whether you go in private asset classes or whether you go in your traditional asset classes, one thing that investors have to do is they have to moderate their expectations about future returns. In particular, future real returns. Inflation where it is right now, it is the focus on real returns that is important. And with this as the background, I think constructing a portfolio or making sure that you get enough exposure to various style factors and even macro factors, it should be a high priority for advisors and investors. And QRG, due to our expertise and ability to customize, can really help in this area. We can put together a portfolio that provides additional factor exposures to what regular market portfolios can provide. Most of the time, these style factors and even the regular factors their correlation to the market is very low, and so having this additional style exposure would increase the expected real, not only increase the expected real return, but also could help with reining in the volatility.
And Brandon, what would your key takeaway be?
Yeah, Bob, I would echo everything Giannis said. And I think at a higher level, Envestnet talks about financial wellness, helping advisors help their clients achieve financial wellness and not just success in their investment portfolios. And so we think that direct indexing in our quantitative portfolios can help them attain that goal. Our QPs appeal to clients who are seeking a low-cost strategy that provides consistent exposure to an asset class, which is really the key element to achieving in the investment objective. Outperforming the market does not contribute that much to achieving an investment objective. Asset class exposure, so setting up that asset allocation appropriately, and then getting low cost exposure to those asset classes, like through our market series or our sustainable series, is really helpful. So they could be seeking exposure to an asset class, or they're hoping to outperform the index through consistent exposure to these asset pricing factors that we've been talking about, or they want to express their values through a sustainable portfolio. The tax efficiency and tax benefits of direct indexing strategies are as I mentioned before, they're measurable and they're real, and I think that's a key takeaway. So low cost exposure to the desired factors or components of the market that the client wants, and being able to customize and tax manage that strategy. I think that's the key takeaway I'd provide for your listeners.
Well, we will include a series of links in the notes that accompany this podcast where our listeners can learn more about direct indexing and the approach that Envestnet takes to it. Those links will include a link to the direct indexing overview and the QRG website on the Envestnet website, and also a link to a brochure about quantitative portfolios. Brandon and Giannis, is there anything else you'd like to add?
No, I really appreciate the time, Bob. It's been fantastic speaking with you.
Yes, same here. Thank you, Bob.
You're welcome, and thank you for listening to the Gaining Perspective podcast with Bob Hoopsher, today featuring Brandon Thomas and Giannis Vingelis of Envestnet. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on iTunes, Spotify, and Stitcher.